You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we've gone over real estate. I like real estate, especially for the coming recession or financial turbulence that the country and the world's going through. A lot of different ways to invest. You've heard people on here talking about car washes, mobile home parks, and the like. Self-storage, I kind of have a special fondness for. I haven't invested in it yet, but at some point I shall. And the reasons are simple. Easy maintenance, low cost, high tax deductibility under accelerated depreciation rules pursuant to Section 179, and a whole host of other things. Right now, Travis Baucom is with us now, and the name of his company is Baucom Capital. And Travis, hey, did you grow up saying, I want to own self-storage centers? Was that your goal in life when you were a little kid? When other kids are saying, I want to be a cop, I want to be a fireman, I want to be a lawyer, a doctor. And Travis was there saying, no, not me. I want to do self-storage.
Yeah, unfortunately, that was not in the cards when I was a kid. I think I was focused on more on being a professional golfer or a soccer player or whatever outlandish dream that would have been. So
for those of you out there who have always wanted to be a professional athlete and rake in the big bucks, but you just didn't have what it took, maybe you can follow in Travis's footsteps. Who knows? Maybe you can even invest with Travis. So obviously something about self-storage attracted you. What was it?
Yeah. So about 10 years ago, I actually bought a house. It was a foreclosure. And, back in 2012, there was a lot of those. And I kind of rode the whole market. We bought one, then we bought three, and then we bought 10. And then for too long, we were buying 70 to 80 houses a year. And we did that for about 5 to 6 years. And I realized that it was going to take a very long time to get as wealthy as I was wanting to get and to get to a place of passive income that I wanted to get to. And at the same time, I was getting very, very burned out. And so like most people who get burned out on stuff, you stop focusing on the details, that sort of thing, and then things start kind of crashing. And so we, in 2018, I decided to close that business and unwind all the assets. It was over 115 houses we had. Total, we had flipped over 115 rentals. As we were unwinding that, we were safely unwinding that. And I was thinking like, man, I got to find something that I can really, really, really exponentially increase my wealth and also just live a lot happier of a life, because I was just working all the time. Buying that many houses was like having a huge construction company, and you were also taking all the risks by getting the loans and taking on all the contractors, that sort of thing. And so getting over the self-storage industry was primarily me going, man, I need to find something that is just simpler and easier. And just in my research, it seemed self-storage, or it didn't seem, it was default rate ever of any real estate asset class. And then it also had some of the best cash flow in the sense that your operating costs compared to your gross revenue is the smallest percentage of any other asset class. So after I cleared out all those houses, I started calling brokers, getting laughed at. Eventually, one of them ended up wanting to have lunch with me. He taught me a lot. And then about 6 months after that, we ended up buying our first facility.
Very cool. So we're talking earlier pre-call. Your property is mostly in the Southeast.
Yes. Heavy in Texas. We have one in Oklahoma, and then we are open and actively looking for this in the Southeast, like Florida is a big, I would say Florida, Georgia, Alabama, Louisiana, and Texas are the big, the states we're really looking for.
Right. And growing populations you want, obviously, because the more the population grows, the more junk you have in your house that you know what to do with. And in the Southeast, less homes with basements. We don't have any in Florida, virtually no homes built. Certainly in the past 40 years, 50 years have basements, because that's where I used to store all my junk when I lived in the Northeast. It all went in the basement and never thought of self-storage. But then I moved, and now I'm a self-storage victim myself. So, so cash flows, tell me returns. What kind of returns you get on these properties?
Yeah, historically, the National Association of Real Estate Investment Trusts have an 18.53% annualized return in the storage asset class. We're seeing IRRs around 22 to 28%, depending on a few things. One of those things would be how much we can leverage it. We have a great balance sheet, and so therefore we leverage pretty high, whereas multifamily asset would be 60 to 65%. We're going up to 80, sometimes even 85%, depending on the bank. We're using local banks as opposed to, national, life cos and non-recourse debt. We're using here local banks as close as we can get. If we get a facility, we want to get a bank that we can possibly get as close to that facility as possible.
So what kind of leverage are we talking about here?
Right, like 80-20 loans is the most
80-20
common thing that we're typically getting.
And
the SBA, say what?
Non-recourse, or is it?
No, those are full recourse. That's on us, and so that's why we tend to take a little bit more equity than some of the other storage guys or some of the other multifamily guys typically take.
Hey, just as an aside, with the whole banking debacle that's taking place now, you think that's going to affect your business model with local banks taking a hit?
It has. We're certainly not able to do cash out refinances. So to back up a little bit, some of these facilities we can buy and we can just look at the market and go, man, that we can really juice these rents. We can get these rents higher. We can cut out this monitor security. We can force place insurance, and we can add a lot of revenue very, very quickly within a 12-month state. So typically, if you're buying a facility that was netting $100,000 net operating income and you make it net $196,000 in that then annual net operating income, what you typically do in a normal interest rate environment is you refinance everyone's cash out. And so within 12 months, the limited partners have their cash and maybe a little bit more
nice
tax-free, quote unquote, until you sell it. And we haven't been able to do that just because we're sitting on 5% rates, and now rates are 7.75% or 8%. We're just kind of idling until that happens. Then on new construction stuff, it's really painful because we were underwriting. It takes about 2 years for a good city to underwrite, or I mean not underwrite, but allow. And it takes about 2 years for your facility to get entitled with the city. And when you're underwriting at a 4% and then you're about to start construction at 8%, you really have to adjust a few things. But with that said, I think this is probably a temporary 3 to 4 year situation, maybe even less than that. I'm a little bit less optimistic than most people out there. I think it'll probably take a little bit longer for rates to come down.
Well, we will see. They might be not going up or going up very little. Fed's talking 25 basis points, and that is in doubt now. 2 questions. You mentioned forced place insurance. That's where your lessees are basically forced to buy insurance from you?
For the most part. So our insurance provider, when they're insuring the facility, they're stating that like, hey, part of this insurance clause is you have to make sure that your tenants have their own insurance. Well, the only way to force that is to force place it. So when you say, hey, from starting in December, this company Safe Lease, which is a company we use, they are going to provide you insurance. You have to pay for it unless you provide your homeowner's insurance to us within the next 30 days. So that's about 20% provide their homeowner's insurance. And then all of a sudden, Safe Lease comes in and insurance is $9 a month for every tenant. And that covers $2,000 a month in insurance claims. And so So what happens at that point from a facility owner side is if the facility is broken into and that a storage unit is ransacked, then they can get $2,000 from Safe Lease pretty quick. They do claims really well. Also, from a facility finance side, we're getting 70% of that $9. So that's about $6.65. And when you have 300 tenants, that's $1,800 a month that just kind of came out of nowhere that you didn't have to increase rents. And that's hitting your bottom line. There's not a lot of expenses coming in from that. So that really increases the net operating income, and therefore the value somewhat substantial, especially when you're doing that over 2,500 units.
Very cool. Very cool. So, all right. Well, answer that question, because I know in mortgages, if you default on your homeowner's insurance, the mortgagee will put in place what's called forced place insurance. You don't get a real good deal on it, that's for sure.
No, you don't.
And, you know, it's something to be avoided for sure. All right. So future, you think there's a potential oversaturation of too many storage facilities around the planet?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base, with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
That's a great question. The best way to answer that is if population stagnates, then maybe. Inside Self-Storage, which is the Self-Storage Association all across America, came out that and stated that development is down 83% from last year. So most developers have stopped. They're holding tight, trying to figure out what they're doing. We are compared to what our original goals were this year and what we're doing now, we've definitely pressed the brakes quite a bit just because of the uncertainty in the market. But generally speaking, Americans are really bad at throwing away things. And as long as we focus in markets that population increases substantially, such as like an Austin MSA or a Houston MSA or a Dallas MSA, then we should just by the industry nature in of itself, we should be totally fine. And there shouldn't be there shouldn't be oversaturation.
Okay. Do you ever sell any of these units?
Yeah, we certainly sell that. You know, our goal is to get the limited partner cash back as soon as possible through a refinance, and then at that point is just to make sure we maintain it, stabilize it, maybe don't increase rates as aggressively as the first year, but just kind of idle and see what happens. We want to sell. We don't have to sell. It's in our docs that we don't, a lot of syndications are 5 to 7 year sells. A lot of their return is based off of selling, where most of our return is based on just lifetime cash flow. And so if we get an offer that is just completely bonkers, then we will totally sell. But generally speaking, we want to give your money back and then keep it and send you a distribution every quarter for the rest of your life.
Do you self-manage the properties?
We self-manage some. It really depends on how rural of a market it is. We have some on-site managers. Generally speaking, the bigger facilities and the bigger markets, we run virtually with just an as-needed facilities manager. So you can call our number on the sign or through Google My Business or on our website, and it actually goes to a call center in Illinois, and that those people are available from 10 a.m. to 7 p.m. Monday through Sunday. So pretty much the big bulk of the calls get answered. And then if there's an issue on site, then the facility manager shows up and takes care of it within 24 hours. The facility manager is also the one that uses that puts the overlocks, the red locks that when you don't pay your bills, that he puts those on there. great thing about overlocks that we use is they're called DaVinci Codes. Basically, they have like a 4-digit, like basically a combo lock that no one knows except the DaVinci website, and you put in the DaVinci serial code, and it says, hey, that's a 1, 2, 3, 4. Once you pay your bill, you can get the code. So that code is 1, 2, 3, 4. You take it off, and you can put it in a little bucket or a little secure, kind of like a postal box. And so by doing it that way, we greatly reduce our operating expenses. We are essentially, there's sometimes that the facility manager only goes once a week. He's required to go once a week by contract just to check to make sure everything's fine. There's hardly ever any issues with any of these facilities. And so most of the time you have less than 5 to 10 people a day go in and out of the gate.
You have video monitoring at these places?
Yeah, every facility has LED lights because they don't use a lot of electricity and they're the brightest. And then we use security that is basically, it's not monitored, but basically if something moves, it starts recording that section in case we need it in the future. It's worked out really well.
That's what I have in my house. You can monitor real time if you want, but better to have the sensors, and lights go on and it sends my app a notification. So I guess something like that. Right. Interesting. Well, so low cost, you don't have on-site sales management. And one question I have, and this goes to the development question. Do you look to do unincorporated areas of counties, or is it preferable to do cities? Because I would imagine with unincorporated area, approvals are much easier to come by because you just go through the county.
That is correct. We have one in an ETJ, extraterritorial jurisdiction, and that was a pretty easy approval. We just had to pay a $350 to show a site plan, a $350 permit fee to add 23,000 square feet to a facility. A lot of the ETJs in major markets in Williamson and Travis County, which would be Austin area, those are just as challenging to build a facility as if it was in the actual city limits. And generally speaking, the best locations are at the intersections, right? Like the highways, the major intersections of the town. You want to be like 50% of your tenants come from drive-by traffic. So you want to be next to the grocery store. You want to be next to the McDonald's, the Starbucks, the CVS pharmacies, that sort of thing. And so that is kind of typically what we're looking for urban building is something that has a lot of traffic just come through. So everybody goes to the grocery store at least once a week. Starbucks a once a day type thing. For a lot of people, McDonald's is a lunchtime delivery or lunchtime eatery. So a lot of people coming through but yeah, we would rather pay more and go through the headache that is longer than just doing the easy build out, another 2 miles that way. We're out of the city limits. We'd rather do the hard stuff, take 2 years to incorporate something, because we feel like that if we ever sell, then REITs, if you look at the quarterly reports of REITs, they always use the same term. It's hard to acquire or hard to develop areas. And typically that's those areas that the city just doesn't want storage, but because they don't want storage, that means there's a lot of demand. So that means like the square foot per unit is a lot higher than it would be like in an area where they're like, yeah, you can do whatever you here. The zoning's super lax here.
And just as an aside, with higher rates and lower returns, you've thought about, or have you lowered the leverage component and put more equity into it?
Can you ask that question again?
So because rates are going higher and and harder to come by, you looked at a higher equity component, lower financing, lower leverage.
We've looked into that. Right now, it's kind of a 1-and-1, meaning a bank is going to lend us at, for the most part, 8% with 20% down, and a limited partner is going to expect a prep of somewhere around 8%. So it's kind of a 1-and-1. If those bank rates ever get higher, 9-10%, and prefs still stay around that 8%, then we're probably going to be doing some sort of creative financing sort of situation where we actually, our limited partners get some debt and they get some equity, something like that. But right now we're still trying to utilize banks as much as possible, just because they are, from a capital stack standpoint, banks are the easiest to borrow money from or get money from.
All right. Okay. Well, interesting. So if people want to find out more about what you're doing, connect with you on the web, how do you do that?
Yeah, you can go to the website investinstoragedeals.com, or if you want to get on Instagram at Travis_BAUCOM.
All right. And if you got a question for Travis, myself, shoot us an email, kl@kerrylutz.com. Go to the show notes to this interview on financialsurvivalnetwork.com to click through to Travis's site. And while you're there, sign up for your free newsletter. Travis, interesting investment proposition. Appreciate you coming on. We'll talk to you soon.
Yeah, thanks, Kerry. Have a good day.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.